Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. Would ask everyone here in-house if you'll be so kind to check that your cell phones have been turned off to avoid any interference as we proceed. And, of course, we will post the program within 24 hours on our Heritage homepage for your future reference. Our internet viewers, as always, are welcome to send questions or comments at any time, simply emailing us at speaker@heritage.org. Two of my colleagues are co-hosting today's event. For our panel presentation later in the morning, John Ligon, our Senior Policy Analyst for the Center of Data Analysis, will host. He focuses on the dynamic economic modeling of federal public policy, analyzing the economic effects of federal tax, energy, regulatory, housing, and housing finance policies. He has testified before Congress on his research studying the economic effects of eliminating Fannie Mae and Freddie Mac. His research and commentary have appeared in publications and online news venues such as Financial Times, USA Today, Housing Wire, and National Review Online. Before joining Heritage in 2009, Mr. Ligon was a graduate research assistant in health policy at Syracuse University, where he received his master's degrees in economics and public administration from the Maxwell School of Citizenship and Public Affairs, and he earned his bachelor's degree in economics cum laude from the University of Nevada, Las Vegas. Opening our program is my colleague Norbert Michel. Dr. Michel is the Research Fellow in Financial Regulations in our Thomas A. Rowe Institute for Economic Policy Studies. He earned a BBA degree in Finance and Economics at Loyola University and his PhD in Financial Economics at the University of New Orleans. Before joining us here at Heritage, he was an associate professor at Nicholls State University for 8 years. While there, he served in 2012 as the Andy Bollinger Endowed Professor, and he earned the 2011 Excellence Award in Teaching and the 2011 Excellence Award in Research. Before he was at Nicholls State, he was a policy analyst for 3 years here with Heritage's Center for Data Analysis. Please join me in welcoming Dr. Norbert Michel.
Thank you. Good morning, everybody. Welcome to the Heritage Foundation. And for those of you who are online watching us, welcome to our event, GSE Reform, Should We End Government Guarantees in the U.S. Housing Finance System? For those of you not familiar with the term GSE, that stands for Government-Sponsored Enterprise, and the two government-sponsored enterprises, GSEs, that we're talking about today are Fannie Mae and Freddie Mac. Both of these companies were around together as publicly traded government-sponsored enterprises since the late 1980s. It's true that Fannie Mae was created in the 1930s, but at the time it was a fully fledged government agency. So they became very different. Fannie became very different through the years, and then as Freddie Mac came on the scene, they became even more different together. They both morphed into very large enterprises that bought home mortgages and then used those mortgages to package and guarantee mortgage-backed securities. So because of the special relationship that they have with the government, particularly a line of credit with the Treasury, they were able to borrow money at a below-market interest rate in order to do that. And as a consequence, they grew very large into two sort of behemoth, if you will, industries, or companies, I'm sorry. And what we could see from the data, I have to do that, from 1990 to 2003, they grew from institutions that were holding about 5% of the nation's mortgages to two companies that were holding roughly 20% of the nation's mortgages. So from about $130 billion of mortgages up to more than $1.5 trillion in mortgages. So they grew a little bit. And then in 2008, they were taken over by the federal government and put into conservatorship for insolvency. And at that time, combined, if you look at the federal flow of funds data, they had roughly $8 trillion in debt, which, believe it or not, exceeded the total debt of the U.S. Treasury, total public debt of the U.S. Treasury. That was 2008 also, back when we had a very small government. So as we try to reform this housing finance system that we have and these two failed enterprises, the question is actually still the same one that was posed in the 1930s, which is, should the government guarantee home mortgages and investors in home mortgages? And oddly enough, the question in the 1930s was answered no. And if you wanted to read a little bit more on that background, there's an excellent Heritage Backgrounder online. It's Backgrounder 2854. No idea who wrote that, but anyway. Oddly enough, even though that question was answered no in the 1930s, Fannie Mae stuck around and just sort of evolved with the rest of the government, and then got a partner in 1970, and we had these two large institutions that have now failed, and that's what we're here to talk about today. Last thing that I'll say before we turn it over to the panel is one of the big controversies surrounding this reform effort that you will hear is if we get rid of Fannie and Freddie, then we won't have the 30-year fixed rate mortgage. And I'm not sure that anybody can answer that for sure. However, we do want to point out that the policy is if you like your mortgage, you can keep your mortgage. Thanks, James.
Thanks, Norbert. And again, we thank everyone here watching the event in person and those watching the event online. I'd like to take the time now to introduce the panel for today's event. We're pleased they all could make it here. For our audience, we're going to have all panelists speak, and then we'll begin a question and answer session after they've each had a chance to give their remarks. So we kindly ask that the audience just hold any comments until that time. Our first speaker today is Mark Calabria, the Director of Financial Regulation Studies at the Cato Institute. Mark is a prominent expert in housing and housing finance policy. Prior to joining Cato in 2009, he served as a senior professional staff to the U.S. Senate Committee on Banking, Housing, and Urban Affairs for 6 years. He also served in senior advisory roles to the U.S. Department of Housing and Urban Development and the Joint Center for Housing Studies at Harvard University. Mark holds a doctorate in economics from George Mason. Welcome, Mark. We'll go to you giving your remarks. You can feel free to use the podium, or you can up here, or you can stay seated.
Well, since I understand that my colleagues all want to sit, I won't break that for them. But let me thank you, John, and thank Heritage, and thank Norbert for the invitation to share my views. I do want to emphasize at first that these are my views alone, do not represent the Cato Institute or anyone else. I also want to be very clear that nothing I say today should be construed as either endorsing or opposing any individual piece of legislation. I generally don't do that. Let me also say before my very good friends in the real estate industry suggest otherwise, I like housing. Not here to attack housing. It's kind of crazy. I actually live in a house, even own it, have a mortgage on it. I even, in full disclosure, take the mortgage interest deduction. None of those things, and actually I should go as far to say, those things actually reinforce my view. I would go as far to say that I actually think housing is one of the, or rather shelter in a general sense, is one of the basic necessities of life. There's an unfortunate tendency here in Washington that if you think something is good, you therefore must think that policies that subsidize it are good. So let me be clear, however, I am absolutely against any sort of government guarantee of any form, of the mortgage market. So how can one be pro-housing but anti-mortgage subsidy? These things may seem inconsistent, but that's only if you don't actually understand how our current system works, because our current system does not facilitate the dream of affordable, accessible home ownership. In fact, our current system encourages households to become highly leveraged, doesn't increase home ownership, for instance, and nor does it increase financial stability for that matter. So, I also want to touch on one issue very quickly. The recent recession, we had about 8 million job losses. I think that was directly tied, in my opinion, to the housing boom and bust. Worth noting, we are still about 2.5 million below the peak. And so we hear a lot in the paper about, Fannie and Freddie are repaying the taxpayer and we're getting our money back. I'm going to set aside for the moment that, much of that is one-time accounting and tax gimmicks that in no way are going to represent long-term value. But I think it's important to keep in mind the cash injections for the Treasury are only a small fraction of the true cost that Fannie and Freddie have imposed upon the rest of us. I certainly attribute a non-trivial percentage of the 8 million job losses to Fannie and Freddie. So it's not simply getting the money back. It's also making sure we don't reproduce a system that causes another boom and bust. And I would certainly emphasize, if we simply retain the current system or we try to make cosmetic changes to it, we guarantee another boom and bust. This is not some 100-year flood, 20-year flood. Maybe it'll go wrong. It will go wrong. So I think it's important to make sure that we put together a system that does not bring us back to where we were. And I'm going to go back to my earlier point about homeownership and give a little history, give a little numbers, since Norbert started us out with a little data. Year I was born in 1969, the homeownership rate leveled off at about 64%. It's important to keep in mind Fannie and Freddie at that time. Freddie wasn't even around. Fannie, low single-digit market share. Fannie and Freddie were irrelevant for the housing market at that point. And so to be very clear, their expansion did not come until the bursting of the savings and loan industry. Now let's fast forward this to the height of the recent bubble in 2007. Your homeownership rate was only slightly above that at 69. It's back to about 64 now. The point being is that since the creation of Fannie and Freddie, the long-term homeownership rate has basically not changed at all. So if one of the arguments for these massive subsidies is to deliver homeownership, hasn't happened. One of the reasons we often hear for supporting the mortgage market in Washington is trying to close racial homeownership gaps. So let me talk about that for a second. Again, at the height of the bubble, the homeownership rate for white households was 76.5%, while that for African Americans was 54%, leaving a gap of 22.5%. Well, let's go way back in history a little bit. Let's go back to 1910, before we had FHA, the Federal Housing Administration, that is, Fannie, Freddie, or the federal home loan banks. What was the racial homeownership gap at that point? 23.5%. So yes, in 100 years, the difference between white and African American homeownership rates declined 1%. Wow, stunning public policy success there. So again, these policies, in my opinion, have not delivered the promises that they've made. They have delivered massive leverage, and they've delivered expensive support for the taxpayer. And I think it's also important to keep in mind, we'll often put this that, well, we need a backstop and therefore we need Fannie and Freddie, as if Fannie and Freddie are the only backstop we have in the mortgage market. That's simply not true. I think, as many of you are aware, the Federal Reserve went out and purchased about $1 trillion or so in mortgage-backed securities. That was explicitly an attempt to support the mortgage market. The Federal Reserve's 13(3) powers, which I'm no fan of, were used to support the asset-backed commercial paper market on the non-mortgage side and on the mortgage side. And obviously, I mentioned earlier, we have FHA, we have Ginnie Mae, we have the Federal Home Loan Banks. One could argue deposit insurance for banks and thrifts also serves as a backstop for the mortgage market. And so while I would eliminate almost all of these, pretty much all of these, the fact is they're there. So even in the absence of Fannie and Freddie, our mortgage market, we would still, put it this way, if you got rid of Fannie and Freddie, did not replace them with anything, we would still lead the world in mortgage socialism. So it's also important to keep in mind, I want to finish up my remarks talking a little bit about what I see as one of the crucial elements of things that get you into financial crises, and that's leverage. Because we've heard a lot of talk about the big banks, we've heard a lot of talk about increasing capital, and so I want to make an argument and then give you a little more data and analysis why I believe this is the case, that the primary driver of leverage in our financial system is guarantees. Government guarantees of the financial system, particularly in the mortgage market. Now let's start with Fannie Mae a little bit. Under the 1992 Act, Fannie and Freddie were required to hold 250 basis points of capital, and as you know, a basis point is 1/100 of a percentage point for on-balance sheet and 45 basis points for off-balance sheet guarantee business. So let's think about that for a second. I mean, 45 basis points may sound like a little bit, may sound like a lot. To put that in perspective, that means that their off-balance sheet guarantees were leveraged over 200 to 1. That, to me, is a recipe for imploding regardless of the credit quality of your assets. It's worth saying that in 2008, under the Housing Economic Recovery Act, Congress gave the regulator the authority to establish temporary increases and permanent increases. Unfortunately, the Housing Economic Recovery Act was only passed months before the GSEs were taken into conservatorship, so we do not have those new minimum capital standards in place. And obviously, that was a little too late. Also worth noting that the 1992 Act established a risk-based capital regime for Fannie and Freddie. Setting aside the fact that it took the regulator about a decade to actually do that, they were never binding constraints even when they were put into place. Also to put a little math behind it, year-end 2007, Fannie Mae's core capital was just over $45 billion. Freddie's was just over $38 billion. So you can think about we had $83 billion in core capital between them, $83 billion, to back $6 trillion in risk. Maybe to put that in percentage terms again, as a percent of assets outstanding guarantee, Fannie and Freddie's core capital was 1.5%. Freddie's was 1.7%. Again, to say this combined, each company was leveraged over 60 to 1. Forget, the arguments that, about the lending quality and the housing goals, which I think are all very relevant and very true. Keep in mind that the foreclosure rate for Fannie and Freddie prime loans from 2009 to 2012 was 3%. So Fannie and Freddie would have been wiped out if they hadn't even made any subprime loans, because essentially they had no capital. Now, why did they are allowed to operate with no capital? Because creditors believed that the government would bail them out and, of course, did not charge them rates that reflected the real market risk. Now, if that's not bad enough, Fannie and Freddie also drive increased leverage in the banking system. Recall under our capital rules, under Basel, the minimum capital is a function of various risk weights that are applied to various assets. So if a bank holds a mortgage on its loan, that risk weight is 50%. The risk weighting for the capital is 8%. So if you think about it, 8 times 50, you're having 4% for a mortgage you hold on your balance sheet. However, if you hold a GSE MBS, the corresponding risk weight is 20%, meaning that you hold 1.6, which is obviously a whole lot less than 4%. So my point being is that you had a system that encouraged banks to securitize loans, sell these loans to Fannie and Freddie, largely with the desire to simply reduce their leverage. An important characteristic to keep in part two is Norberg mentioned the 30-year mortgage. What is unique about the 30-year mortgage is not the credit risk. All mortgages have credit risk. Arguably, a 30-year mortgage has less credit risk. What is unique is the interest rate risk. But Fannie and Freddie do not keep the interest rate risk. The investor in the MBS takes the interest rate risk. So when Bank of America sells 1,000 mortgages to Fannie Mae, buys back that 1,000 mortgages in MBS, which was quite common, it is the Bank of America that keeps that interest rate risk, not Fannie and Freddie. So the argument that somehow the 30-year mortgage or that interest rate risk would go away is simply false, because that's not how the system works to begin with. With that said, I think it's important to keep in mind, I'm going to end with a couple of just estimates and give you some sense of why I think the changes in leverage have ended up, which is, if we had instead, and there are lots of problems with the too big to fail banks that I think need to be addressed, but if whole mortgages had been held by banks instead of Fannie and Freddie, we would have had over $200 billion more in capital in our financial system, which I will note is about the size of the capital injection program under the TARP. So again, we don't want to recreate the same incentives. Guarantees, we're going to end up with massive leverage, and ultimately the subsidies we have really haven't delivered much in terms of home ownership.
Thanks, Mark. Those are great remarks. Our next panelist is Arnold Kling. Arnold is a foremost economist specializing in housing finance policy, financial institutions, macroeconomics, and the inside workings of America's federal financial institutions. He's the author of 5 books and an essay writer for the widely read Library for Economics and Liberty, and he blogs at askblog.com. Arnold holds a PhD in economics from Massachusetts Institute of Technology. Welcome, Arnold.
I'm not a coffee drinker. I risk falling asleep if I'm sitting down, so that's why I'm standing up. Okay, so thanks for inviting me here. It's a pleasure to be here at Heritage. And the topic, as I understand it, is something like, should government guarantees for housing finance be ended? Yes, next question. Now let me make 2 analogies sort of to describe kind of the kind of pending proposals to reconstitute government guarantees in housing finance. One analogy I would make is with the ethanol mandate. I think by now pretty much everyone across the ideological spectrum believes that the ethanol mandate does not serve a good public policy purpose, and yet there's virtually no chance of eliminating the ethanol mandate because it serves special interests. And I think that's the same problem that we confront with government guarantees in housing finance. I think I think anyone across the ideological spectrum would say that the potential public policy benefits, here I'll give you a visual, are pretty low, but the potential benefits to certain interest groups, especially Wall Street and mortgage bankers, are very high. In fact, without a government guarantee, you probably wouldn't have mortgage securitization, which would put mortgage bankers out of business, and it would keep Wall Street pretty much out of the mortgage industry. And certainly from their point of view, that would be a disaster. So it's a tough battle fighting against a government guarantee, but just but from a public policy point of view, from the point of view of the typical citizen and taxpayer, those guarantees don't deliver much benefits. So that's one analogy with the ethanol mandate. The second analogy has to do with some of these proposals really want to stand up an entire new business process, a new government guarantee agency underlying new mortgage business process. And I have opposed that for a long time. I wrote something a couple years ago for Mercatus on a couple of proposals, and both of my proposals were to sort of go back and tweak something that worked before. So go back to the savings and loan model. That's one approach. You would tweak that by sort of requiring more risk-based capital, and also hopefully you wouldn't rerun the inflationary policies of the 1970s. The other option would be to go back to Freddie and Fannie and tweak that model by taking care of the leverage issues that Mark raised, that is, have them hold genuine capital and hold much more of it. Also, maybe move them to a regulator who cares about their safety and soundness. We had the irony of HUD regulating safety and soundness and the Fed regulating consumer protection. That seems like that should have been reversed, or the Treasury really should have been regulating safety and soundness. So those are, and the reason I want to start by tweaking old models, well, I tried to go into at length in the paper about the problem of implementing business processes. I see Tony Sanders sitting there, and he reminded me I have this online course for mortgage regulators at something called MR University. And I spent a lot of time in that course talking about business processes. And that's because, I felt I really had to emphasize how important business processes are and how difficult they are to set up and so on. Anyway, I have a simple analogy now for that. I don't have to go through all those lectures. I just think mortgage.gov. Okay, so if you want to, if you're trying to, stand up a whole new business process, just imagine what that's going to look like. Okay, so that's why I'm worried about a lot of the proposals that are coming down the pike, is that they support these special interests, some of the same businesses that kind of got us in trouble in the first place. They don't have a great public policy purpose, and we're trying to stand up something new. So the question is what to do about it, because I don't think people here, we're all friends and we might be all agree, but we're not going to stop this. I mean, because every congressman has realtors in their district, they have home builders in their district, and chances are Wall Street and the mortgage bankers are going to be able to mobilize the rest of the housing lobby behind proposals for government guarantees. So we've got a tough challenge. If it were me, I would actually be trying to engage some left of center think tanks on this. I would ask the folks at Brookings and the Urban Institute to do a allocate who you think is going to benefit from these government guarantees. How much of it is going to go to Wall Street firms, how much of it is going to go to mortgage bankers, how much of it is going to go to affluent homeowners, and just show people that distribution. The other thing I might ask a left-of-center think tank to do is compare our housing finance system with the housing finance systems in other countries, notably Canada. Canada doesn't have the 30-year mortgage, and as you know, that has disastrous results. Canada has had wide housing cycles, has a home ownership rate of 5%. No, actually Canada has a more stable housing finance system with at least as high a home ownership rate as the U.S. And there are other countries that you can point to as well. And the only other political thing I would do, let's just assume that we can't stop this train, that they're going to go ahead and come up with new mortgage guarantees. I would try to limit the scope of them. Just say, come on, seriously, there's no public policy purpose in government guarantees that back cash-out refinances, home equity loans, ARMs, investor loans, just this whole range. If we could just limit the scope of guarantees so that it only covered 15 and 30-year fixed rate for purchase or for rate and term refis. That means a refi where the borrower doesn't take any cash out but just gets a lower rate. If we could just restrict it in that way, that may be about as much as we can hope for. Maybe I'm being too pessimistic, but that's that I think is, I would actually count that as a victory given the power of the housing lobby that we're up against. Thanks.
Thank you, Arnold. Our next panelist is Alex Pollock. He's a resident research fellow at the American Enterprise Institute. Alex came to AEI after serving 12 years as the president and CEO of the Federal Home Loan Bank of Chicago. He has a deep knowledge of the housing finance sector, having had a 35-year career in banking. He is the author of the book Boom and Bust, Financial Cycles, and Human Prosperity. Alex holds a Master of Public Administration from Princeton University and a Master of Arts in Philosophy from the University of Chicago. Welcome, Alex.
Thanks, John. Thanks for having me. Well, now, in 1969, when Mark Calabria was born, I was a trainee at the bank, and we were experiencing the credit crunch of 1969. The credit crunch of 1969 involved a terrific mortgage credit crunch, directly and obviously caused by government regulation. In those days, the ceilings on deposits, on interest rates on deposits, so there wasn't any money for mortgages because the market rates had gone over the ceilings. Well, what does the government do when faced with a crisis created by its regulation? Does it get rid of the regulation? No. Then instead we got the Emergency Home Finance Act of 1970, which created Freddie Mac, another intervention to fix the failures of the previous intervention. And so it goes. Well, on a couple of answers, I find myself in a great deal of agreement with my colleague Arnold. Should we end government guarantees? Yes, at least in my view, for 80% of the mortgage market. I could imagine a mortgage market that would function pretty well with running on an 80% an actual market of private capital and private activity and a 20% government sector, which, however, in my view, should be always under the control of approval and appropriation by the Congress and never on some kind of automatic, we set aside slush funds out of housing revenues that the Congress can't control and doesn't appropriate. I also agree with Arnold that we have a problem in doing anything about this because of all of the people who benefit from the government guarantee of mortgages. Indeed, a government guarantee of mortgages you could think of as a giant sow with very many little piggies attached to it, and all these piggies don't want you to take away the nice warm milk they're getting from the sow. And so while we can say, what does such a government guarantee do? We know what it always does. It always distorts credit, always distorts resource allocation. It results in excessive credit, excessive leverage, and excessive house prices. And it does this by making it possible for people to shovel money into housing credit while not having any credit risk in case that credit goes bad. This is bound to be a distortion, to break the link between the risk being created by the credit and who bears the credit. It's a little bit sobering that right now, for example, 25% of the Ginnie Mae securities, a real government guarantee, are held in China and Japan, just like huge amounts of Fannie and Freddie bonds and MBS were held abroad because people were offered a free lunch. You can put this money into the American housing market. You can help this market run up its prices, run up its risk, run up its leverage, but you will have no risk at all. I tell this little story. It goes, who would you trust, a bond salesman or a government official? And when it came to Fannie and Freddie, if you listen to the government officials, they said, oh no, Fannie and Freddie aren't guaranteed by the government. Why, just look at their offering memoranda. It says right here in bold-faced type, not guaranteed. And bond salesmen, on the other hand, sold Fannie and Freddie bonds and MBS all over the world, and they said, they had to be a little bit careful what they said, but basically what you got as the message was, this is government paper. You got no problem. You're going to get a higher yield, and you got no risk. Who was right, the bond salesman or the government officials, like secretaries of the Treasury and chairman of banking committees and things? The answer is the bond salesman told you the truth, as was clear in retrospect. So these guarantees are in essence and necessarily distortive, and they're distortive in the way of running up risk and leverage by breaking the link between pushing in money and the risk that's being created. Now, it's said we should always ask cui bono, just as Arnold was suggesting. Who benefits? Let's see who benefits from higher house prices created by distortions of excessive credit, created by cutting the link between risk creating and risk bearing. Well, we have some obvious cases. Sellers of houses benefit greatly from higher house prices. Builders of houses benefit greatly from higher house prices. All of the building trades that work on such houses all benefit from higher house prices. And in general, if we're expanding credit, mortgage bankers and Wall Street benefit. Politicians are happy about that. Do existing homeowners benefit from higher house prices? Well, not if they have to. If they sell this house, if they have to buy another one, they're not really ahead. Heirs of estates which contain houses benefit from higher house prices, but buyers of new buyers of houses are greatly penalized by higher house prices because we've made the house less affordable. So ironically, by attempting through government guarantees to make housing more affordable, we make it less affordable by running up the price. Now, we can't understand today the situation with Fannie and Freddie, in my opinion, without thinking of what I call the government triangle of mortgage finance. Government triangle of mortgage finance right now has three different parts of the government. The Treasury Department, Fannie and Freddie, and the Federal Reserve. Now, why can't any private securities compete with Fannie and Freddie securities now, especially now? Well, it's because the Fed is buying up essentially the entire production and creating high prices for these securities and low yields. And we have the really astonishing situation of approximately $1.5 trillion of mortgage securities sitting on the books of the Fed. And the price of these So backed off a little bit after the maybe we'll taper speech, but nonetheless the price of these are high. And the Fed is rather in the situation of that famous buyer of the penny stock who bought the penny stock and it went up, so he bought some more, and it went up, and he bought some more, and it went up. And he finally calls his broker, as you will remember this famous story on Wall Street, and says, I've got this huge profit, now it's time to sell. And the broker says, who do you think you're going to sell it to? This is the situation of the Fed right now with the $1.5 trillion of mortgages they've bought. And we really, in my view, ought to think of the problem as even bigger than just the government guarantee of mortgage. It's this government triangle putting the government into the mortgage business, because you can think of this triangle as actually only one thing. Fannie and Freddie are part of the government, and so the Fed is part of the government. The Treasury obviously is the government. Think about them as a consolidated set of books. It's going to create one set of books, put all these together, and all of the transactions between them will become consolidating eliminations. What have you got? The government buys mortgages by printing money. So we have the monetization of the mortgage market. On one side you have money printed, on the other side you're buying mortgages. That's really astonishing, and it's bound to create even more distortions than the government guarantee we should also get rid of, at least to 80%. Now I have one final point to make. Fannie and Freddie are doubtless systemically important financial institutions. But oddly enough, the government's FSOC, or Great Risk Body, has not designated them as such, as SIFIs. If you put Fannie and Freddie on a list of all of the SIFIs by assets, they are number 1 and number 4 out of about 50 or 60 SIFIs. But they obviously are great creators of systemic risk with their government guarantees and with their triangle relationship, as just discussed. Why aren't Fannie and Freddie designated by the government body responsible for thinking of systemic risk as SIFIs, as creators of systemic risk, which they obviously are? Well, that might lead you to a conspiracy theory. They obviously are SIFIs. As SIFIs, how much capital should Fannie and Freddie have? Picking up on Mark's comments, well, at least as much as any other big SIFI, so at least, let's say, 4 or 5%. If you have $5 trillion in risk and 4 or 5% capital, that means you need about 200 to 250 billion in capital. And if Fannie and Freddie could raise another 200 or 250 billion in capital, then I'd be glad to have them pay off the government's preferred stock. But we cannot avoid, in my opinion, answering the question, what's the right capital requirement for a Fannie and Freddie? If they continue for a while, because it does look like, because of the problem of the government guarantee being the big sow, nothing is going to happen legislatively, at least in the near term. So what are we going to do in the intermediate term? We at least ought to settle this SIFI status and this capital status. A final point, you have to think always about the interrelationship of the banking system and Fannie and Freddie, as Mark was also saying. The banking system was used to hyper-leverage Fannie and Freddie, because not only did they buy Fannie and Freddie debt and MBS, they bought Fannie and Freddie equity. A lot of Fannie and Freddie's equity was in fact held by the banking system in the form of preferred stock. What leverage was allowed on that for the bank? Answer, 60 to 1, 20% risk weighting. So if you think about the relationship between the banks and Fannie and Freddie, the regulatory rules created hyper-leverage. Hyper-leverage always feels good while things are going up, and always feels bad, of course, when things are going down. And hyper-leverage guarantees they will go down in time, and all of this intervention in the form of government guarantees and favorable rules and subsidies is well thought of as creating hyper leverage in the mortgage market, which I fully agree we have to correct. Thanks.
Thank you, Alex. And rounding out our panel is Josh Rosner, Managing Director at the independent research consultancy Graham Fisher and Company. He is a principal advisor to regulators, institutional investors on housing and mortgage finance issues. Prior to Graham Fisher, he served as Managing Director of Financial Services Research for Medley Global Advisors and an Executive Vice President at CIBC World Markets. Josh is a co-author of the best-selling book Reckless Endangerment, among other groundbreaking papers on housing, structured securities, and rating agencies. Welcome, Josh.
Thank you very much for having me. I have a feeling that I'm going to be taking a somewhat different point of departure here and suggest that the problem wasn't the charter of Fannie and Freddie at its root. The problem that led us to the crisis that we lived in were the distortions of the charter, the government interventions to expand the mission, and as a result, the opportunity for the companies to go from really nothing more than secondary market player utilities to earnings growth stories. In the wake of the S&L crisis, the government saw a wonderful opportunity to move the GSEs off their balance sheet, to largely move housing off balance sheet, and proceeded to do so. In '92, the GSEs got a new regulator, new capital standards, both of which were gamed by the companies. In 1994, the administration, supported by the largest public-private partnership ever created, which included the home builders, the mortgage bankers, the realtors, Acorn, La Raza, Fannie, Freddie, Treasury, the new regulator, HUD, and others, created the National Partners in Home Ownership with the goal of creating record levels of home ownership by the end of the millennium, and do so through innovative financing, lower down payment requirements, among other means. Now, the result created the opportunity for, by '96, the GSEs to begin a process of a rapid move to expand their portfolios and really become earnings growth story companies. Inadequate capital, large portfolio growth. In July 2001, I authored a paper titled Housing in the New Millennium, A Home Without Equity is Just a Rental with Debt. And I'll read you from the executive summary of that 2001 paper. There are elements in place for the housing sector to continue to experience growth well above GDP. However, we believe there are risks that can materially distort the prospects of the sector. Specifically, it appears that a large portion of the housing sector's growth in the '90s came from the easing of credit underwriting process. That easing includes drastic reduction of minimum down payment levels from 20% to 0%, focused effort to target low-income borrower, reduction in private mortgage insurance requirements on high LTV mortgages, increasing use of software to streamline the origination process and modify or recast delinquent loans in order to keep them classified as current, changes in the appraisal process that have led to widespread overappraisal, overvaluation problems. That was 2001. The paper concluded if these trends remain in place, it's likely that the home purchase boom of the past decade will continue unabated despite the increasingly more difficult economic environment. It may be possible for lenders to further ease credit standards and more fully exploit less penetrated markets. However, I warned, as unemployment rises, interest rates rise, or home prices falter, the virtuous circle of increasing home ownership due to greater leverage has the potential to become a vicious cycle of lower home prices due to an accelerating rate of foreclosure. So,
The voice of him that crieth in the wilderness.
so what happened? Why did they fail? And what's legislation intending to do now? I think it's important to understand when I talk about the legislative initiatives in Washington, my comments are really, should be very clear. I come here not to praise the legislation, but to bury it. You have to start with the question, are we addressing the real reasons that the GSEs failed? Inadequate capital, the use of portfolios, which made GSEs pro-cyclical. Remember, these were intended to be secondary market players to be there when liquidity wasn't. And instead, their use of the portfolio made them primary market players functionally because they were investing in primary market product in a very real way, driving a race to zero and becoming pro-cyclical. Reduced underwriting standards to compete with the primary market, mixing of mission of the primary market players with those of the secondary market players is a toxic mix of commingled goals and arbitrage opportunities. Delivering social subsidies by market participants only furthers distortions. If you look, as example, at Corker Warner, among its many other problems, it creates a market access fund, which once again commingles public and private goals. Okay? This is a significant problem. I'm stuck with the question of who else but Congress would say that we have a problem with Fannie and Freddie and replace them with entities that are tasked with essentially the same purpose, but managed by our too-big-to-fail banks, banks that both aisles of Congress and both houses want to reduce the interconnectedness and systemic risk of. Yet Corker Warner places the primary market players at the center of the secondary market, again, commingling those goals. The current role of the central role of too-big-to-fail banks, moreover, would result in regional and community banks becoming little more than third-party originators for too-big-to-fail institutions. Beyond that, Corker Warner puts in place a waiver on the first loss piece in a crisis. That's a disaster. First loss is tied to liquidity. Building an ability for the regulator to lower that 10% first loss position when liquidity dries up would result in markets backing away at the first whiff. They would game the system. Moreover, even real and hard rules, as we saw in the crisis, were thrown out. So why would we feel comfortable having wishy-washy rules that claim to work except when we need them not to work? Moreover, there is, unfortunately, on both the House and the Senate legislations offered, a failure to recognize that at this point there is not enough capital to reach the goals. Using private mortgage insurers as an example, the mortgage insurers are already levered 20-to-1. The federal regulator, under the new plan, would probably reduce allowable leverage, thus requiring even more capital. Well, look at what's gone on. The private mortgage industry has $7.3 billion of capital. Only $3 billion of that has been raised since the crisis. Yet GSE origination since 2009 are $5.3 trillion. Do the math. There's not enough capital. There's not enough capital for a first loss position. And if you assume private mortgage insurance backstops the top 20% of mortgages, the industry would need 10 times more capital than it has. Moreover, part of the reason that the PMI industry has failed repeatedly through its creation since the beginning of the last century was that they do not do loan level pricing. Okay? And by the way, it would probably be called redlining if they did. PMI is state chartered, not federal chartered, which is another problem with Corker Warner that no one's addressing. Yes, you can create a federal capital requirement that has to be met in order to do business with the FMIC, but capital gets drawn quickly, leaving the feds to either face rescissions or accept state forbearance. That's exactly the same problem that occurred with the GSEs. Okay? So we're trying to solve, we're not even trying to solve the problem, we're just trying to move the chairs. The risk and cost to build the new system contemplated in Corker Warner, moreover, and the risk of the Greenfield project's failure to replace a damaged system should be obvious in the wake of Obamacare. The FMIC would be responsible for creating standards across the secondary mortgage market, including for servicing and private mortgage insurance. How are we leaving this, again, to policymakers rather than markets? Moreover, if you look at the G fee under Corker Warner, it shouldn't be based upon volume. It disadvantages the community banks. It shouldn't be determined by the FMIC and Treasury. They have demonstrated that they can't really do a great job at risk pricing or estimating cost. If you go back and remember, when the government seized Fannie and Freddie They said there was less than a 5% chance that the cost would be more than $100 billion. Okay, and a year later, they commented, both FHA and budgetary offices, that the GSEs would never be able to pay back the government. Moreover, they ignored the fact, or they weren't able to price the need for appropriate levels of GSE capital. Beyond these and a million other problems that we can point out with current legislative proposals, if you start looking at the specifics, they create a whole other problem. And specifically, that problem is to pass legislation that you know will be tied up in litigation, potentially for years, is a bad strategy. If you read Section 502D, Treasury seizes existing mortgage guarantee books of the GSEs. 601, the new FMIC agency seizes the existing multifamily mortgage guarantee business of the GSEs. Section 502E, the Treasury gives no credit for the valuable assets seized or money already received. It liquidates other assets and puts uncredited government obligations first in line, in other words, double dipping in bankruptcy terms, and maximizes the return for senior preferred shareholders, but no one else. Section 502E3 and 4, the Treasury Secretary and the new agency head decide who gets what without maximizing value, allocating under absolute priority, or any judicial review. So ultimately, I expect that those issues, the more micro issues in the legislation, really should be considered before we watch the 11 co-sponsors move forward in trying to move this legislation, or in leadership, Crapo and Johnson, including much of the base text of Corker-Warner in their legislative proposal. The legislation doesn't really address the underlying issue. The secondary market was intended to be an opportunity for liquidity to be provided to the market when private markets cannot access liquidity. And if you stop and think about that as the thing you should drive for, one, it means that whoever that secondary market player is needs to be well capitalized. Two, they need to have as small portfolios as possible, liquidity-only portfolios, otherwise they risk becoming pro-cyclical. And three, they should not be spurring a race to zero, which they wouldn't if they didn't have portfolios. They should be there to provide liquidity when liquidity disappears. And so I'd like to hope that over the next several months, since I don't really see prospects for legislation moving, that we'll start having a rational discussion about why Fannie and Freddie failed, capital in portfolios being among the primary drivers, whether we need to start from fresh cloth as a result, or repair. And repair can be as fully private, repair can be as fully public, but you have to consider the rights of the existing owners. You have to consider the goals for the housing market. The goals for the housing market should be to understand that home ownership is not a person who takes out a mortgage. Home ownership, in its traditional sense in this country, was the monthly payments of principal and interest to build equity in a home so that at about the time of retirement you can have a mortgage burning party, have the largest intergenerational and retirement asset for most American families, a forced savings plan, and that anything short of a person who has no mortgage is a journeyman on the road to home ownership, not a homeowner. We've deluded ourselves. And the goal should be home ownership, not the constant use of the housing asset as a piggy bank. Thank you.
Thanks, Josh. These were all really, really great comments and remarks. I'd like to turn to this issue of capital and getting capital back, private capital back into the market, and I'd like to put it in the context of Basel III and Basel III requirements. So I'd like to ask a question basically to the panel. How costly are Basel III capital requirements? How enforceable are these requirements? And what are the implications for private capital into the U.S. capital markets without a federal guarantee behind the U.S. secondary mortgage market? So just throw that to the panel, and whoever has any kind of comments, feel free to just chime in.
I guess
my first thought is I don't think of, sort of there being fixed piles of capital. Capital emerges in response to incentives. And, when somebody says, well, the banks don't have enough capital to fund mortgages, I say, well, if at the right interest rate, banks will have enough capital to fund mortgages. So I start there. As far as the Basel capital requirements, it's a losing battle that the regulators are fighting to sort of try to design some kind of capital requirement that's going to that banks aren't going to gain. So anyway, I don't see that. I'm such a pessimist on the ability of government to just sort of, I'll come up with some really clever incentives and we'll get exactly what we want out of it. That I don't think that'll happen. But I think I guess what I'd have you take away is if you hear somebody pound the table and say, we need a government guarantee or else we won't have enough capital to fund mortgages, be very skeptical. That's, that person is probably focusing on a special interest and doesn't really have a good economic model in mind of how capital flows.
I would just point out, in relation to that last remark, that that's true, except in an environment where you've got the Fed underpricing credit to the inability of private capital, therefore, to price appropriately, which is where we are now. So when I say that there's not enough private capital, it's largely because the Fed, and frankly legislators, would feel very uncomfortable if we allowed rates to go where they need to go to bring in the appropriate amounts of private capital to support the system. Is there enough private capital? Yeah, there would certainly be enough private capital, but it would be several hundred basis points higher. And while that would actually result in more appropriate risk pricing, I don't see any legislative or regulatory will to accept that cost at this point.
And that's exactly why we need to get rid of the Federal Reserve.
I have one comment on Basel, if I may. The newest Basel, like the older Basels, continues one of their biggest mistakes, which is to consider sovereign credit as a special either zero capital or very low capital risk. And included in that are entities of the government like Fannie and Freddie. While much of the talk about Basel is, there's bigger capital requirements for one of the biggest causes of disasters, both here and elsewhere, like in Europe, which is the undercapitalization of credit that's tied to a government in some fashion. It simply continues the previous mistakes.
Well, and just as we have in Corker Warner this, we have a rule unless we need to do away with the rule for a period requirement on the first loss. The inadequacies of Basel III are recognized globally, and so the implementation will be different in every jurisdiction, which undermines the concept of a bank standard on a global basis. And that's evident in the U.S. proposal on the leverage ratio, right, which really is putting a belt on a body that supposedly already is wearing suspenders and is a higher bar than Basel III.
Great. I'd like to shift gears a bit and go to an issue that has been raised here at the panel, which is this 80-20 split between the private sector and then a portion of the market, mortgage and secondary mortgage market that would be backed by the federal government. And so in that context, I'd like to throw a question to the panel, what role, who would take up that 20%? Is it primarily the FHA? If it is, what's the role for the FHA? What does that look like? And maybe talk to that in the context of what some of the bills that are in the House and the Senate right now. Mark,
I'll start us out, and maybe this is where Alex and I would differ a little bit. I see it more like a 100-0 split, that I see 100% of the risk borne by the private market. I think one of the things worth parsing out, we often talk about, and Arnold touched upon the fact that, we don't see these level of subsidies in other countries. One of the very big differences between the U.S. and the rest of the world is that in most of the rest of the world, if you as an individual have a very poor history of paying your bills, you generally don't get a mortgage. And we have an entitlement culture in this country that it doesn't really matter whether you have a good credit history or not, you're entitled to a mortgage. I have no doubt at all that the private sector can completely finance, 760, 800 FICO mortgages with 10% down. No doubt about that. I, in my life, would never, ever lend my own money to anybody with a 580 FICO. That's a grant, not a loan. And so as long as we're going to have that mentality, then we're going to be in trouble. And so I do think a part of the conversation needs to be not how do we get people with bad credit into mortgages, but how do we help them fix their credit should be the conversation. And so that's where that 20 is. I just wouldn't have that 20. I would help those people repair their credit, if anything.
But, the notion of the private markets are able to is somewhat fallacious at this point. Look, here we are, years after the crisis, and part of the crisis, a big part of the crisis, frankly, the GSEs had their role, but the private market players had their role as well. And frankly, in 2006, when I started warning we were about to have a credit market collapse that would bring down housing, it was at the end of the day because you had 300 different pooling and servicing agreements. You had no standard of definition of delinquency or default. You had unclear roles of trustees as representatives of investors relative to the securitizers who chose them. You had very poor disclosures. Actually, you didn't have any disclosure other than weighted averages of what's in a mortgage-backed pool before the deal went to market. And here we are this many years later. The private market has not come back at all. And the reason it hasn't come back is they still haven't fixed any of that infrastructure problem. There still has been no honest effort to provide investors with the information, the clarity of contract, the rights, the obligations, and the duties of a trustee to support them that would be required for the private market to come back. And so, in an ideal world, I agree with you, Mark, but we don't live in an ideal world.
If I could parse out what I mean by a private market is not trying to reproduce a private securitization market. To go back to Arnold's two choices, I think we need to return to a largely deposit-based model. We need to remember that mortgages will sit on somebody's balance sheet. Do sit on somebody's balance sheet. We acted with Fannie and Freddie that they just went into some sort of dimensional black hole and disappeared. No, they sit on somebody's balance sheet. And so, the whole securitization to me was a bit of a fraud. It was a circular regulatory arbitrage. So, to me, the private market should largely be somebody's willing to hold this on their balance sheet if we let them, if you deal with the legal problems, which are certainly there.
But I agree with you, but then one would ask, we've got record levels of deposits at our largest institutions, and they aren't filling that role.
So there's a couple of reasons for that, in my opinion. And for
I'm not questioning reasons. Okay. I'm saying the private market isn't functioning.
And I would argue for regulatory reasons.
Well, and again, you have, as I think everyone's raised, that you've got a public market that's sort of crowding them out. I mean, so we don't know what interest rate it would settle at if we did have a private market.
Don't disagree.
I agree definitely with what Mark said about sort of the 100-0, and I would say that instead of worrying about repairing people's credit, or maybe in addition to, worry about getting people to save for a down payment. I mean, if we didn't have the existing interest groups and the existing mindset, and I think this goes along with what Josh said, what you would have, instead of promoting home borrowership, you would have people coming, government's role would be to encourage savings for a down payment. And if you sort of, if you could start from a blank piece of paper and get the interest groups out of the room, I think that's where you would end up, is government support for savings rather than government support for mortgages.
Mr. Chairman, as the proposer of 80-20, perhaps I should say a word. The probability of, under any circumstances, of getting 100 zero marks is literally zero. I would be thrilled if we could get to 80-20, and I think we all should be thrilled. I do think that the reforms to the FHA, which has its own bunches of bad loans and problems that are contained in the House bill, the PATH Act, are very good. I think the separation of it from the Department of Housing into a corporation, which could be better understood by everybody, is a very good proposal. Let me just say on savings, I couldn't agree more. Among the things I've done in my checkered career is to run a large savings and loan. The savings and loan was formed in a second story over a bar in a working class suburb of St. Louis in 1933. And we still had the original contracts by the creators of the association. And the original contract was a piece of lined notebook paper. And on this page, you joined the association and you entered into your savings contract. And you promised how much you would save. $1 a week, $2 a week, $5 a week, and then you signed your name and you pledged to save. And they had this very sound idea, which is that the same behavior which causes you to be a regular saver will be the behavior which causes you to regularly pay off your loan. I think it's a marvelous old piece of financial wisdom we've completely lost. One final historical note, and this is a little bit of an argument with you, Arnold, and in general I agree with almost everything you say. That is mortgage bankers and government guarantees. Mortgage bankers have come to love government guarantees, but there were mortgage bankers, and they had plenty of business before there were any government guarantees, and they originated mortgages, and the mortgages were sold to insurance companies. And that was always one of the channels forever in American mortgage finance.
You know, I would just, Mark and Alex both heard me rail about this. If we were to start with a fresh piece of paper, why wouldn't we create a Roth IRA type down payment or first-time renter savings account on a tax-free basis? And why wouldn't we replace the mortgage interest deduction, which has limited benefit, with what I call a principal equity tax credit, so that you'd have a progressive tax credit that gives you an incentive to make payments, and on an annual basis, based upon the amount of principal paid down, you would get a tax credit. If you want to subsidize the increasing home ownership rate in a stable, sustainable manner, that would be a much more appropriate way to do it.
Okay, well, now that we agree that the government should encourage tax-free savings and have a 100-0 split, we're going to open it up to audience questions, and Phyllis, we're going to walk around with our mic. Sorry.
I think we have a question right here.
Hi, I'm Matt Buckham. First off, I want to say that the removal of the interest rate manipulation by the Fed or other regulatory agencies or regulators would be amazing. So, Norbert, I agree with you.
That was all determined at the Cato conference yesterday. It had nothing to do with me.
But this question is more for Mark, and the rest of the panel, you can chime in. Assuming there is a slow removal of the 30-year prepayable fixed-rate mortgage without the federal backstop, how would existing homeowners benefit, those that wanted to sell their homes? And also, how would potential home buyers benefit? Also, kind of a tag along that question, you can choose to answer. The same groups, how would they benefit if the interest rate subsidy was removed?
So it's interesting that you start with the point about the Federal Reserve, and of course it made me think about it when we talk about the incentives for savers, because obviously in a zero interest rate environment, there's not a very big incentive to save. But one of the things I think is not as commonly understood is when you compare the U.S. to other developed economies, one of the reasons that fixed rate mortgages are so more predominant here is that as bad as the Fed has been, if you go back and say, look at pre-Euro Bank of Italy, for instance, the Fed starts to actually look relatively decent. And so one of the reasons that you've seen a 30-year mortgage here relative to much of Europe is, again, as bad as the Fed has been, lots of other central banks have just been so much more horrible. For instance, post-World War II, pre-Euro, the average annual inflation rate in Italy was 9%. Who's going to give you a fixed rate mortgage in that environment? Nobody. And so part of this is going to have to be what's the interest rate stability, what's the inflation expectations going forward. So one bottom line issue would be what the Federal Reserve does over the next couple of years will have a far bigger impact on mortgage rates than anything we do in mortgage finance reform. That will be the primary driver. So setting all that aside, which is outside of the scope of this discussion, but certainly incredibly relevant, I think if we did start to get rid of some of these subsidies and you started to see prices come down, I think it's important to keep in mind we do not have a national housing market. The interest rate subsidies are largely capitalized in the houses in supply-constrained markets. So, for instance, if we got rid of all the guarantees that were there, you'd see almost no price impact in Houston, but you'd probably see about a 10% decline in some place like San Francisco. I look at San Francisco where the median house price is 8 times median income and say, it's hard for me to believe incomes in San Francisco are going to increase 800% anytime soon. So the direction should be lower house prices. Just as our current system is a regressive transfer from renters to owners, removal of that system is a progressive transfer from owners to renters. So this is the inner progressive in me talking, that I'm not necessarily opposed to that. And I say that as somebody who has a very large mortgage and owns a property here in DC, that there's going to have to be a one-time redistribution. It will be a one-time redistribution, again, from wealthy homeowners to renters. I can live with that to remove the distortions that are in the system. And I think we'll have a far more stable system at the end of the day. To Arnold's point, there are lots of industries that whose income is a commission percentage of home prices. Those industries will suffer, but the overall economy will be better. One of the arguments I would make, and I do appreciate Arnold's point about our friends on the left, I am sympathetic to some of the arguments that we've seen wage stagnation for a number of decades. But I think that's because we've had a bubble-driven economy, and so what I mean by that is, if you want to grow wages, the way you do it is you grow labor productivity. Running up house prices does not increase the productivity of labor. So I often look at it and say it's not a problem that we borrowed trillions of dollars from the rest of the world. The problem is that we used it to build up house prices rather than invest in human capital, build plants and equipment, things that would have actually made us more productive and wealthier as a country. And so we don't talk about this in a broader sense, and this is one of the reasons why I would have not jumped on some of the tax proposals, because as a general matter, I think our tax code should solely be about revenue and not about incentivizing anything. So I'm for low, simple rates. But that said, we really have not had a discussion of why are we favoring housing over other sectors of the economy, and that's part of the discussion here. We way overinvest. So one of the things that I would push back on some of the earlier conversations, I guess, about not enough capital is I don't start from the premise that we want to reproduce a $10 trillion mortgage market. Given the current housing prices, given the current population demographics and such, I wouldn't want a mortgage market bigger than $7 trillion with what we have today. It's way too much money we've thrown at our mortgage market that would be better spent for our society elsewhere, and let the market figure that out.
Great.
Another question. Let me go over here.
While he's getting the microphone, Mark, I want to point out that according to Arnold and Josh, if you have a big mortgage, you don't own your house, really.
And I agree with that. Despite I have a fair amount of equity in it as well.
My question is for Josh and the panel. If the main purpose of the federal backstop in the housing market is to provide for a liquid housing finance system, why does S1217 Corker-Warner include an automatic mechanism at even higher levels than current law for the Housing Trust Fund and the Capital Magnet Fund? Could you speak to the implications of creating automatic financing to federal housing slush funds?
It's a terrible idea, and it has nothing to do with liquidity. It has to do with trying to get votes on the left-hand side of the Senate.
I mean, that goes exactly to the point of the reason the GSEs failed is they became off-balance sheet tools for the government to drive subsidies through quasi-public, quasi-private companies. That's not endemic to their necessary role. It's just as we're seeing in the current push, the way Washington likes to work. And so you need to have the public be private, the private be the public be public, the private be private. And it isn't to provide liquidity. It's to provide liquidity when liquidity isn't there. That's the appropriate role of a secondary market. And the commingling of those goals was, again, because of the inadequate capital requirements and the use of portfolios. And the fact is that, you know, if any of you read my book, Reckless Endangerment, one of the things that we really focus on is the political largesse offered by Fannie and Freddie, right? They were the kings and queens of ribbon-cutting ceremonies, building special junket alliances with congressmen and senators. And at the end of the day, they wouldn't have had that power were it not for the growth that they saw as a result of their portfolios. They would have been much smaller companies. I think that's really important to remember, that their role was because they were trying like heck to creep into the primary market. Now what you've got in Corker Warner is the risk of commingling the primary and secondary again, but this time not by allowing secondary market players to try and creep into the primary market, but giving primary market players the control over the secondary market.
I can maybe ask a question of Josh, and I preface this with, this is not an endorsement of either of these proposals, and it's not, I don't want to characterize you saying that. And I don't want to characterize you as saying that we need to have a liquidity backstop. But let's say we need to have a liquidity backstop. My question would be, can you not solve that either through the Federal Reserve buying of even whether it's private label MBS, whether it's is the Federal Reserve not a lender of last resort, or B, when I look at many of the proposals, I look at this and say, well, it looks like somebody's just trying to recreate a Ginnie Mae for the conforming. Well, you have Ginnie Mae. I don't like it, but you got it. Could not expanding Ginnie Mae to the conforming solve much of the problems that Corker Warner tries to solve?
There's a million ways that you can solve the problems that Corker Warner tries to solve. And, you know, again, I'm not sure why we're trying to recreate the wheel, which is what we're trying to do. You know, you could do it in a million ways, including by saying that, you know, the notion that Fannie and Freddie just provided a credit risk price, a G fee, they probably should also have, as secondary market players, had to price liquidity. Where there was adequate liquidity, they would have put a probit fee so that there was a disincentive from wrapping, right? And then everything that was therefore securitized directly would have been fully private, no guarantee, no risk to the government, no risk to the taxpayer. You cannot live in a world where you can price credit, but you don't have to price liquidity without that resulting in excess liquidity.
And just a quick answer on the Ginnie Mae. They don't have any facility for guaranteeing credit risk because they're taking
the FHA component.
Yeah, but they're taking the credit risk is taken care of by the FHA. Now, if you tell them go to the conforming market, now they've all of a sudden got to say, oh, we got to bear this credit risk. Well, how are we going to?
Or get somebody else to bear it in front of them.
But that's a mess. Yeah.
Could I just make a point on Mark's comment about why not the Fed? This is a historical point. At the time when Fannie Mae was created and also Freddie Mac, the conception of the American financial system was that housing finance and mortgages were separate from commercial finance. And that was the old, we used to call it in housing finance circles the special circuit. You had a special circuit of financing for houses that was different from financing enterprise, financing commercial things. And the main mortgage lenders, the savings and loans, did not have access in those days to the Federal Reserve. Well, that's all changed. Now, that's all the special circuit idea is gone, and the Fed is perfectly capable, I agree with Mark, of providing lender of last resort services if needed to mortgage credit, as it obviously does, whereas historically that wasn't viewed to be the case.
Although the lines between lender of last resort and lender of first resort
Yes.
are very unclear, as we know.
If we go quickly, we can get we maybe get two more questions.
Thank you. Josh, you kind of talked on the shortcomings of the Corker Warner bill, but to the rest of the panel, do you see how this offers any protection for taxpayers from the kind of losses already experienced under Fannie and Freddie?
Well, I want to say that Corker Warner and its senator, Corker, of course, does insist on private capital in front of the government, and that to have some percent, 10% in front of the government is a whole lot better than zero.
No, it's not real capital.
And well, nonetheless, it's an idea that I praise them for. However, note that the very first thing, and maybe this is predictable, that gets attacked in Corker Warner in most discussion is, well, that 10% is too big, let's make it littler. That'll get in the way of giving more people loans. But nonetheless, in my opinion, the stress on creating private skin in the game is a good one. I'd like more.
Go maybe one more question right here.
I just wondered what the panel's thoughts are on proposals that have emerged recently from holders of the junior preferred securities of Fannie around basically privatizing them, buying them, putting private capital in immediately. Again, the level is a question. What do you all think of it?
Well, I'll quickly say, to me, the important caveat, really is the charters. I'm going to channel Alex here because one of the things I love about Alex is his knowledge of history. So if we basically did an Andrew Jackson style, get rid of the Second Bank of the United States and make them go to Pennsylvania to get a bank charter, if we get rid of the charters, I'm happy to let the junior preferreds have that lovely 3900 Wisconsin Avenue building. They can have the assets of the companies to the extent that those assets are greater than the liabilities. But the charters, nobody should be getting a congressional charter here. If they want to go take the assets and get a bank charter or thrift charter, whatever, more power to them.
With corresponding capital requirements.
Yes.
Yeah, I would agree. And go a little bit further, which is, that notion that we just three of us all agreed on is nowhere in any of the proposals, right? Now we've got this wonderful taking. We've got a wonderful sweep, which is doing a great job of allowing Treasury to push off days of reckoning elsewhere in the budget discussions. And there's, the breakdown of contract that's occurred.
We'll do one more question, because we're not quite at 11:25, so let's maybe come down here. And if anybody wants to stick around after this just for a few minutes, you can come up and talk to the panel, and that's perfectly okay, but we're going to need to wrap things up after this question.
First off, I'd like to start off and thank everybody for doing this panel today. This was great. I heard a lot of discussion about Corker Warner and some mention of the House proposal. Does anybody have any other comments on the PATH Act? I heard Mr. Pollock say some agreement with some of the concepts of that.
Look, the PATH Act, to me, as I said before, has an unrealistic field of dreams aspect to it right now, right? Build it and they will come. And the reality is, as long as the Fed's doing what the Fed's doing, they're not coming. Moreover, I have some other problems with it, including the fact that, and Alex and I have discussed this, and while intellectually I agree, functionally I disagree, the movement of all of the GSE liabilities directly onto the government balance sheet right now is problematic when there are other alternatives.
Josh, they're already there.
They are
Not legally.
not legally there.
I mean, it's an interesting wrinkle, and it's worth mentioning that both Corker Warner and the PATH Act
Exactly.
hardened the guarantee.
Yep.
Yes.
And I'd certainly say the guarantee is harder than it was before the crisis, but it's worth saying there still is no statutory backing of Fannie and Freddie's debt, and so
right.
it's at least worth remembering.
Well, let's actually put in legislation, to get rid of all of the gaming that's going on around whose assets they are and who owns what, which right now in both bills is ultimately left to arbitrary legislative and regulatory decision-making. Why don't we just put the GSEs through bankruptcy if we're creating new legislation, and let a bankruptcy court and a trustee decide what the value of the assets are and who they transfer to?
That would look bad.
It would be honest.
Would it be? Let's come back to the PATH Act. I wish it could advance. I think almost everybody agrees that such an act, however appealing in concept, which I think it is unlikely in the extreme to be enacted. I think the Senate bill is also unlikely to be enacted, and so what are we going to have? We're going to have some continuation of this weird status quo that we have of the government triangle dominating the mortgage business. We really need to fix our minds on somehow addressing if we can't improve the status quo somehow.
It would, yeah, well, it would certainly be nice if we could let the right amount of capital enter the mortgage market. And as Mark points out, maybe that's a lot less than what we have now, and the tragedy is that we build lots of plant and equipment and invest in worker train, you know, and I'm not talking about as a government investing, I mean individuals investing in training themselves, and the capital goes there rather than into inflating house prices.
Okay, well, thank everybody for coming, and we thank our panel very much.